Hello students, welcome to BYJU'S. Welcome to a session on Explained. Very recently NITI Aayog has come out with a report titled New India at 75. That is, in the next decade, we are going to complete 75 years of independence. So in this particular direction, what are the areas or what are the reforms that the government of India should take, keeping in mind the present situation in various sectors? This particular report has got more than 20 chapters and the number of pages are more than 260. So the complete report cannot be done in a single video. So what we'll be doing is, we'll be taking some of the very important topics or chapters in this particular report and preparing a very short video on each of these particular chapters for your benefit. So in this particular video lecture, I'll be having discussion with respect to the first chapter in this particular report, that is titled Growth. Now, what are the important points given in this particular chapter? Basically, they start with the objectives. They basically state 4 very important objectives in this particular report. The first 2 objectives are related to growth. The first objective is to ensure that for the next couple of years, that is from financial year 18 to the financial year 23, the GDP growth rate for India crosses more than 8%. And once this particular 8% growth rate is achieved, the GDP value of India will increase from the present level of around $2.7 trillion to around $4 trillion. That is the first very important objective that has been mentioned here. The second objective, again related to growth itself, they basically state that the growth that is achieved in the next couple of financial years must be inclusive, must be formalized, must be sustainable or sustained, and fourth, must be clean. That is, in simple terms, it should be inclusive. The benefits of the growth must reach every section of the society. That is inclusiveness. Second, formalized. Formalized in simple terms means that majority of the economy today is under the informal segment. To bring it into the formalization basically entails that people will be guaranteed protection of jobs or security of job, tenure will be guaranteed, the incomes or the salaries will be guaranteed, social protection will be provided to these particular employees, so on and so forth. So second, the growth must be formalized, growth must be sustained or sustainable growth. And most important, whatever growth we achieve should be clean. In simple terms, the impact on the environment should be very minimal. So these are the 4 objectives within the growth concept that has been recommended by this particular report. The third very important objective that has been mentioned is to increase the investment level. Now please understand, there is a very close relationship with investment and growth. Higher the investment, it will lead to higher growth in any of the economies. That is a rational outcome. Now basically in case of India, post 2012, there has been a slowdown in the investment rate. This particular report states that the investment rate should be increased from 29% of GDP to 36% of GDP by financial year 23. This is a third very important objective. And fourth objective that has been mentioned in this particular report is related to the exports. Again, when I say exports, it is related to the exports of goods plus services. As for 2018 numbers, the total value of exports, again combined with goods and services value, comes at around $478 billion. This particular report basically states that we must increase from 478 billion to $800 billion. This is the fourth objective that has been mentioned in this particular report. So these are the 4 objectives. First one is growth. Ensure that the growth rate is 8% post financial year 18 to 23. Second, growth must be formal, inclusive, sustained as well as clean. Third one is the investment should be increased from present level of 29% to 36% by 2023. And finally, the exports, total value of goods and services exported from Indian economy should increase to $800 billion. These are the objectives. Now, they have mentioned certain issue with the present situation. They basically state that though it has been more than 25 years since we have implemented the LPG reforms, that is liberalization, privatization and globalization, the contribution of manufacturing sector to the total GDP growth rate in India has not been very satisfactory. Now when I say not very satisfactory, this has been evaluated in comparison with other countries or other economies which are having the same income level. So when I compare India with its peers, the contribution of manufacturing sector to the total GDP has not been satisfactory. Now, this particular outcome has been because of two very important reasons. One, they basically cite the issue with the skilled labor in India, or in simple terms, they basically say that we have not been able to harness the labor productivity in Indian economy. Now, this has been because of the concept of a skilled labor only. No doubt, India has got one of the largest availability of labor forces. As per census of 2011, the total labor force that is present in case of India is more than 760 million. And by 2025, this is going to increase to around 869 million. Now, this is a very huge amount of a labor force, no doubt. But please understand, to harness this particular demographic dividend, we must ensure that this labor is skilled labor, which increases the productivity of the labor. As per various surveys, it has been found that just over 10% of the labor force in India has got any kind of an accessibility or any kind of a exposure to the skill set. And that is the precise reason the productivity of Indian labor is very low. That is one issue. And the second issue that this particular report has flagged is the issue of a complex labor laws. Now, please understand, the subject of a labor law falls in the concurrent list. That is, the central government is allowed to formulate the laws on this particular subject, as well as the state government is allowed to formulate the laws. As a result of this, it has been found that in case of India, there are more than 200 labor laws which have been formulated by both the central government as well as the state government. That has been the complex nature of the labor laws in India. So basically, these are the two important points or two very important issues that has been flagged by this particular report, which has basically not allowed Indian economy to harness the highest output or the potential output from the manufacturing sector. Now, what is the way forward? The recommendations have been given. I'll just go through these particular recommendations, and these recommendations have been put under 4 heads. Let me start with the recommendations. 1. The government of India should increase the public expenditure. Now, please understand, if the investment have to be increased, as mentioned in the objectives, from 29% to 36%, the investment either has to come from the public source or the private sources. In case of the public, we basically focus on the expenditure incurred in the form of investment by Government of India. Whereas in case of a private sector, we look at the households as well as the companies or the firms. So under the public head, this particular report states that we must increase the expenditure or investment, to be more precise. Now, how it can be done? 1, we will have to increase the tax to GDP ratio. Please understand, there is a very close relationship between the tax as well as the GDP. For a simple reason, it is a matter of fact that the GDP increase should lead to increased economic activity. Again, it's a reinforcing cycle. That is, once the economic activity increases, we basically say GDP has increased. And with increased GDP, again we expect more economic activity in the coming years. Whenever this particular economic activity increases, we basically expect the collection of taxes to increase. So with increase in the GDP, the rational output should be increased collection of taxes. In case of India, the tax to GDP ratio is around 17%, which is the lowest amongst the BRICS community. In case of China, it has been found to be around 22%. In case of South Africa, it is 27%. In Brazil, it is somewhere in the range of 34%. And in case of India, as already mentioned, it is 17%. So please understand, taxes form a very important source of receipts or revenues for Government of India. If you want to increase the investment done by Government of India, you must increase the receipts or revenues. And one way to increase this is increase the tax to GDP ratio. This particular report recommends that it should be increased from 17% to 22%. That is first. Second, there are huge number of central public sector enterprises which are loss making. As per the latest report, more than 180 central public sector enterprises in this particular year have reported a loss of more than 1.2 lakh crore rupees. So basically, a large number of CPSEs are loss making. The government should exit from these particular loss making CPSEs. Now, whenever this kind of an exit happens, one outcome will be the expenditure incurred by Government of India will come down. Second, the government of India will sell these particular companies to, let's say, a private sector. It will lead to the revenue or receipt collection by government of India. And third, this will drive up the private sector participation in these particular sectors. So basically, it's a win-win situation for all the stakeholders in the economy. So government of India should exit the loss-making CPSS. Third one, the GFCF, gross fixed capital formation contribution from government of India has been around 4% of GDP. It should increase over a period of time so as to increase the investment done by the government of India. That is basically the public sector investment. Second, from the private sector, how do you drive up the investments? One, introduce more and more FDI reforms. Basically, once you introduce FDI reforms, that is foreign direct investment reforms are introduced, we expect huge amount of inflow of dollars into India. This will not only benefit the balance of payment situation for India, it will also drive up the investment in various sectors. And more importantly, this particular report has stated that Government of India should implement the Kelkar Committee recommendations. This particular committee was set up by Government of India to give recommendations in the PPP sector, that is public-private partnership sector, which will basically lead toward investment in infrastructure. And this particular committee has given huge number of recommendations. Some of the very important recommendations are distribution of the risks amongst both the participants, that is the private sector participant as well as the public sector, that is the government, as per the risk handling capacity. Second one, do not allow the state government to participate in the PPP infrastructure projects or PPP projects generally. Third one, set up the 3P India. Fourth one, amend Prevention of Corruption Act. Fifth one, have a national framework for PPP, so on and so forth. So a large number of recommendations have been given by this particular committee. Government of India should implement these particular recommendations. Now, with respect to monetary and fiscal policy, what are the recommendations given by this particular report? One, RBI should maintain the inflation level between 2% to 6%. That is first recommendation. Second one, lot of issues with respect to balance of payment, especially the trade deficit as well as the current account deficit. One of the leading factors has been the volatility in the exchange rate. For example, in the last year itself, there has been a huge depreciation of Indian rupee. As a result of this, our trade deficit will expand, imports will become costlier, current account deficit will expand, so on and so forth. Hence, there should be certain reforms introduced to control the volatility in the exchange rate. And third, with respect to public debt. Public debt is nothing but the total money that the government of India owes. The public debt is very high, around 47%. It should be dragged down. Already there is a recommendation given by NK Singh committee which basically recommends that the public debt should be dragged down to 40%. So Government of India is taking a lot of measures and this particular public debt should be brought down in the coming years. Next, whenever you fix the fiscal deficit, this is usually done before the financial year actually begins, that is during the budget. This particular report states that fix the fiscal deficit based on the macroeconomic parameters. What is the meaning of this? There would be certain situation wherein the Government of India should incur a higher expenditure. And when the Government of India incurs a higher expenditure, there is a danger that the fiscal deficit target is going to be breached, or there is no way that the fiscal deficit target is going to be met. So in this particular situation, decide your fiscal deficit based on the macroeconomic parameters. This is another recommendation given in this particular report. With respect to financial market, it basically says that the household savings as well as the savings from other private sector participants must be channelized. Please understand, higher the savings, higher will be the investments. That is a basic rational output that is going to happen in any of the economies. I'll give an example. Let's assume here is a household. It makes a earnings of 100 rupees. If all the 100 rupees is used for the immediate expenditure or immediate consumption, such as let's say food, it will not invest anything in the market in the form of let's say fixed deposit. Why? 100 rupees is earned, 100 rupees has been spent. But what if the household uses 40 rupees for immediate consumption and keeps 60 rupees in the form of a fixed deposit? Now assuming there is no CRR, SLR, so on and so forth, the bank will take the 60 rupees, give it as a loan, let's say to a company, which will purchase raw materials, have production process, which will basically lead to what? Higher GDP or contribution to GDP. So please understand this, channelize the savings. Higher the savings, higher will be the investments. Second one, introduce banking reforms. Lot of issues in Indian economy are having a genesis because of certain issues in the banking sector. Now this particular report recommends that commercially driven boards must be set up, and second, certain free hand or freedom should be given in terms of the HRD policies, human resource development policies. That is in simple terms, hiring and firing policies. So these are the two recommendations in the financial market. Finally, what are the recommendations with respect to exports and manufacturing? One, the power tariffs must be rationalized. In case of India, the power tariffs, especially the tariffs which are imposed on the industries, are on a higher side when compared to the global market. So the rationalization of the power tariffs has to be done. Second, the logistics sector, the cost of transportation is higher in case of India. For example, the logistics or the cost of logistics in India is somewhere in the range of 14% of GDP. Whereas in case of China, it is somewhere in the range of 8%. In case of developed markets, it is much lesser than 8%. So you will have to optimize the logistics sector. Third, whatever infrastructure projects are stuck up or whatever issues are there with these particular infrastructure projects, clear all these particular issues, ensure that these particular infrastructure projects are completed on time. For example, Delhi-Mumbai Industrial Corridor. And Government of India has identified 12 sectors which are related to services and has labeled these particular sectors as champion sectors, such as IT and ITES, tourism, medical, value, etc. So these particular 12 champion services sector should be promoted. So these are some of the recommendations which have been given under the concept of exports and manufacturing. So this is in a nutshell the gist of the first chapter, that is growth, in the NITI Aayog report that has been titled as New India at 75. Thank you. Have a good day.